Hi everyone, can you hear me? Yes? Yes, no, guys, can you hear me?
Yes, sir.
Okay. All right, guys, let's start. Okay. So today you will be studying a very, very interesting topic, right? I know some people are moving closer to their exams, but today's topic is one of the most interesting topic in at least FRM part one, even in finance, right? So this topic is so interesting that if you go and you know any good financial website, they will always talk about it. So we are talking today about your Black-Scholes-Merton model, BSM, right? And why Black-Scholes-Merton model is very famous. Basically, this was the first model which actually kind of came out and gave a framework to predict the option prices, right? See, options have been in the world for very long time, but if you talk about when they were used in exchanges, so it started around the 1960s, 1950s. But in the initial years, people never understood how to value the options, right? So there was no mathematical framework, right? People used to value the options randomly, right? It was a gut instinct or it was some naive formula, right? Very, very simple. Then came the binomial model, right? Binomial model was another attempt to predict the option prices, which we did last time. But that also was not so great, right? Because you saw last time, right? How binomial model was used, right? You could only do it for two time steps, right? And you have to put it that, okay, upside probabilities P, downside probabilities 1 minus P, and then SU, SUU, SUD, SDU, SDD, right? And all these things, which we did last time, guys. And American option and European option, we did all these things last time, right? So that was the basic framework which was there in late 1960s, early 1970s, right? In 1970s, right, Mr. Black, Mr. Scholes and Merton, right? Three people came together and built a model called Black-Scholes-Merton Model, BSM model, right? And this model was, when it came out, people didn't appreciate it that much. But after a few years, people started realizing that this model was very, very good and this model was way ahead of its time. And in fact, in 1990s, 1994 or 90, somewhere that time, right? They got a Nobel Prize also for this model, right? This model is so famous that what you are reading today is a piece of art, is a piece of history, right? This model has got Nobel Prize, right? Like people who made this model have got Nobel Prize in your economics, right? In finance, right? So that's why it is so popular. And if you go and search about it anywhere, right, you learn. You go to any business school, IIMs in India or Ivy League in US, every business school you go, this is one of the favorite topics of people who want to study finance deeper and all those things, right? So it's a very interesting topic. Why I wanted to give you a background here was because you must appreciate that this is such a relevant topic, or this is such a nice topic, part of a history kind of thing, right? So that's what I wanted to talk about. Okay. With that introduction, let's start, right? See, in FRM, we are bothered more about passing exam and all those things. So maybe we'll not appreciate the beauty of this model that much. But if you're not like running for the exams and if you're just learning it casually, then you realize that how good this model is. What were the assumptions? What were the I'm not saying this is the perfect model, right? There are certain gaps in this model also. But at that time, when there was nothing, this model was really good because this was the first model which came out with some kind of analysis, and people were able to appreciate that how to think about options, right? So it's a very interesting model in that sense. Okay, so let's start, guys. Let's start digging deeper and trying to understand this particular model. Okay, so all right, let me share my screen. Okay, so this is a Black-Scholes-Merton model, still being used, even though there are better versions of this model has come now, but the classical model is still studied a lot everywhere, not only in FRM, right? It's studied everywhere in business schools, in Ivy League, everywhere. People start from here and try to understand the modern way of pricing your options, right? So Black-Scholes-Merton model, they have three topics here which we'll try to understand. First topic here is about your stock price and return distribution. Second is your Black-Scholes-Merton model. Third is your dividend warrants and implied volatility. Just to give you more background, like where are we right now? So today is 1st of August. We are doing this one. This topic, Black-Scholes-Merton model. Tomorrow we will do your option sensitivity, which is your Greeks, right? We'll focus on that. Okay, and then 8th of August, we'll start with book number 1, right? Just with the perspective you should be aware of. Okay, now let's go deep, right? So module 1 will talk about which is stock price and return distribution. See, you have studied quants with me. You understand why we study distributions in finance. We study distributions in finance because by studying distribution, we are able to predict we are able to understand the behavior of a particular element, right? Let's say how the stock price behave, how the return behave, right? Similarly, here, since we are dealing with stock price, return, etc., we want to understand that behavior, right? So topic number 1 is about distribution of stock prices and return. Topic number 2 is expected value. Topic number 3 is estimating your historical volatility. So these are different topics we need to keep in mind, right? And you have to understand these properties, right? So why do we want to understand stock price and return? Because the objective is that to understand the options, we need to be very clear about the behavior of the stock price and returns, right? Expected value, volatility, all these are kind of inputs or the factors which affect your option price as well, right? So let's talk about your distribution of your stock price as well as returns, right? Let's talk about that. So here, when we talk about distribution of stock price, we're talking about log normal property of stock prices. The first one is your Black-Scholes-Merton option pricing model assumes that stock prices are log normally distributed. Stock prices are log normally distributed, right? Log normal distribution, I hope you remember what was log normal distribution in quants. Log normal distribution is something like that, which starts from 0, right? Log normal distribution does not start from negative, right? It's log normal distribution. The minimum point is 0, right? And it's on the positive side, right? Why do we have stock prices as log normally distributed? Because we understand that, right? The minimum price of a stock can be only 0, right? Stock cannot, we have never seen or we will never see stock going below 0 price, right? So that's very, very important. LNST, which is logarithm, natural logarithm of stock price, is normally distributed. Now, this is very surprising. Please understand ST. ST is log normally distributed. But if you take natural log of ST, that becomes normal. Okay, so keep that in mind. When you take natural log of ST, that becomes a normal distribution, right? Formula here, please remember this formula. I don't want to go how this was derived because there is a derivation for this formula. If you don't want to go there, just remember this formula. This is a very important formula. This basically tells you how to think about your stock price, right? How to think about your stock price. If we take the natural logarithm of the stock price, we get a normal distribution N. And if you see in the bracket, what is in the bracket? There is ln S naught, right? Plus your mu minus sigma square by 2 into T, comma sigma root T, right? So what I'm trying to, if you don't remember or if you don't know what is how does a normal distribution works? See, normal distribution has two things here. One is mean, one is your kind of, what you say, this form. Normal distribution with mean M and standard deviation S. So the first part, right? The first part, which is your this part. This is your mean, right? In fact, T will also come here. Just keep that in mind. T will also come here. Don't keep out T. T will also come here, right? And the other part, this part is your standard deviation. This is the form, guys. This is the form. MS. This is the form. M is if whatever in between there's a comma. So this is the mean of the distribution. What I'm trying to say here is that please understand this is the general form, right? You don't have to think too much here. Just have to remember that when we take the natural logarithm of ST, ln ST, it becomes a normal distribution. If you don't take natural logarithm of ST, it's a log normal distributed, right? So which is given in the first line. And please understand what is ST. ST is the stock price at time T. S0 is the stock price at time 0. Mu is the expected return on stock per year. Sigma is the volatility of the stock price per year. And this is the general form, right? Why do we need to remember this? Because this tells us the behavior, the property of how the stock price moves, right? That is why we are studying it, because ultimately option depends on the underlying, right? So we need to understand how the price moves, right? And then we have distribution and rates of return. The Black-Scholes model assume that stock returns. A lot of students who are studying for the first time become confused. See, this is stock price. This is returns. Price and return are not same. Price is price. Return is what you made in a year, right? Returns are normally distributed. Please keep in mind. In exam, they test this question. Stock returns are normally distributed. Stock prices are your log normally distributed. So stock prices are like this. Stock return, if somebody is asking, it is normally distributed, which means the mean is 0 here. It can have negative value also. It can have positive value also, right? Because return can be negative also. Indian market has been underperforming for last 2 years, right? So 2024 we hit 26,300. After that we are always below that, right? So we are having a negative return for Indian market for last 2 years. But stock prices cannot be negative, right? Mean of continuously compounded return, right? So we'll talk about distribution on rates of return. Please understand, if somebody asks you mean of continuous compounded return, it is given by this formula. Mu minus sigma square by t. Again, just remember it because this comes in exam, right? So mean of continuously compounded return, right, is given as, again, it is returns, not price. This was prices. This is return. Return formula is not given. Return only few things are given. So remember, mu minus sigma square by 2 is the mean of returns, not the mean of your prices. This is mean of returns, right? Mean of returns, right? Then we have standard deviation of continuously compounded return. Standard deviation is same. Please remember this. So I hope you are getting the point. In the above equation on the top, right, we are talking about stock prices. In the below equation, we are talking about stock returns. In the stock prices, we are saying that mean is what? We are saying mean is ln S0 plus mu minus sigma square by 2. In stock returns, we are saying mean is only mu minus sigma square by 2. In stock prices, we are saying standard deviation is sigma root t. In your returns, we are saying standard deviation is same. So returns and prices, standard deviation is same. But mean is not same, right? Remember that point. Volatility will be lower for longer time periods based on the standard deviation formula, right? So again, for longer time period, volatility will be lower, right? Why? Because, okay, sorry, I made a small mistake. Please understand the, such a stupid mistake we made, right? Log normal property of stock prices, the standard deviation here is your sigma root t, right? In your rate, in your returns, it is not sigma into root t, it is sigma divided by root t, right? Basically, this is the stupid mistake I made because actually volatility becomes lower for longer time period returns, because as t increases, t is in denominator, t increases, so the total value of volatility or standard deviation goes down. Please remember it, guys. Here, as in your prices, if the time period increases, standard deviation increases, variance increases. In your returns, it is sigma by root t. If your time increases, actually the return volatility decreases. Okay. So this slide looks a very simple slide, but there are a lot of questions which can be asked from here, right? Because ultimately they want you to understand that what is the distribution of, first of all, stock price and returns. Then what is the mean of stock price? What is the mean of stock return? What is the sigma? What is the volatility of, what is the standard deviation of your stock price? What is the standard deviation of your return, right? So remember that point, right? Very, very important. One is sigma into root t, one is sigma divided by root t. Okay, this is what I have done. Stock returns, negative, positive, always log normal, always start from 0, etc. Right, very simple. Okay, let's do this question, guys. XYZ stock has a current price of 30 and an expected value in 9 months of 34. The expected annual return is closest to, right? See, the expected value is going for 34, right? In 9 months, right? In 9 months, right? What do you think is the expected return, right? This question actually, see, in 9 months, if it goes from 30 to 34, right, which means it is more than 10% return, right? In fact, 11.13 to 11, yeah, 11% kind of thing, right? So, but that's for 9 months. So this cannot be the answer, right? Then question comes, what will be the answer, right? Let's see the solution. It will be given in a very simple form for 9 months and then compared to 12 months, right? So this is, again, with the current price of 30, the future stock price 34, and time period of 9 months, the formula setup is very, very easily. They have used very simple formula, right? So they have used what you say, future value kind of thing, right? Which is 34 is nothing but 30 exponential your whatever return you're saying ERT. Here R is basically not the risk-free rate, it is R, the return of rate which you are looking for, right? So that's what you're trying to figure out, and 30 into exponential R is you want to find out, T is 9 by 12, 9 months out of 12, right? So you can solve it, right? Here you have to find out this R. Right? So very, very straightforward, very, very simple, right? I don't think this question will come in exam. Nobody asks such question in exam. This one is tricky. Assume a portfolio has the following asset return: 6%, 2%, 8%, minus 3%, right? What is the realized portfolio return, right? I want to give you a hack here because you might not have studied it. Because see, when you have a portfolio which has multiple assets, and let's assume that they have equal weight, because nothing has given me in question that what is their weight, right? Then you have to use 1 plus R formula, right? 1 plus R formula, I'll show you. Right, so this is the formula, right? What you are doing is 1 plus R1 into 1 plus R2, right? So 6%, 2%, etc. into 1 plus R3 into 1 plus R4, right? And then, right, why it is under root, just to, if you are getting confused, or why it is under root, basically, this is 1 plus return of the portfolio raised to power the number of stocks which is there, right? So there are 4 stocks, 1 plus RP raised to power 4 into your 1 plus R1 into 1 plus R2 into 1 plus R3. Just remember it, guys. This is a unique kind of formula. 1 plus R4. That's why it is raised to power. This answer is -1, right? So, or it's 1 by 4, whatever you want to take, right? But the formula is like this. If it had been a 5 stocks, then it 1 plus RP raised to power 5. 3 stock, 1 plus RP raised to power 3, right? And this is 1, 2, 3, right? It's just simple thing, right? 6% was taken as 1.06, 2% 1.02, 8% 1.08, minus 3%, 0.97, and then taken 1/4 root minus 1. So that's, again, this might be asked in exam, to be fair, because this is a little unique kind of thing. Then we have the expected value, even though we have already done the question, because this is very similar to what we have learned in fixed income also and everywhere also. Please understand, stock price is nothing but, future price nothing but, or expected value is nothing but S naught E mu T. Mu is the expected rate of return. A stock currently priced at 25 with an expected annual return of 20%. Expected value of stock in 6 months is this, 25 into exponential. What is it? 20% is 0.2 and 6 months is 1/2, which is 0.5 with this, right? Realized return for a portfolio, which I told you, same thing, 5% minus 4, 9 and 6. 5% becomes 1.05, minus 4 becomes 0.96, 9 becomes 1.09, 6% becomes 1.06, raised power 4 minus 1, 3.9%. Okay, that is what it becomes. Then we have estimating your historical volatility. Right now, when you're reading for the first time, you always get confused that, sir, why are we focusing on estimating historical volatility? We are focusing on historical volatility because one of the inputs to your Black-Scholes model is your volatility, right? And we have to use that historical volatility, right? Because there is no other way we can do it, right? -1, okay. -1 is nothing like, okay, let me explain. See, -1 is happening because this one, I hope you're getting my point, right? Basically, 1 plus RP, when I put 1 plus RP, this will become what? This whole thing raised to power 1/4, right? I have to find RP. RP will be what? The whole thing 1/4 minus 1, na? Make sense? Make sense? Okay. Okay, perfect. So a lot of people get confused, sir, why are we focusing on estimating historical volatility? The basic reason is that volatility is an input to Black-Scholes model. Ultimately, next module is about Black-Scholes model, right? So if you have to understand Black-Scholes model, we have to understand its inputs, and this is one of the inputs, right? So what are the different ways to estimate volatility? First of all, please understand there is called a scaling of volatility. Scaling of volatility means that if you know volatility for 1 day, can you find volatility for 10 days? Let's say if you want no volatility of 10 days, can you find volatility of 1 day, right? So volatility for short time periods can be scaled to longer time periods by multiplying by the square root of the number of periods, right? Let's say if the weekly standard deviation is 5%, the annual standard deviation is root of 52. Basically root of t, right? If you know volatility of 1 day and you want to find 10 days, so volatility of 1 day multiplied by root of 10, right? This part, this will be root of 10, right? You get volatility of 10 day. Right, volatility of 10 day, right? So that is what we get. Then next part is volatility estimation process. Right, volatility estimation process. Right. First is collect the daily price data. Right. Again, understand how it is done, even though nobody will tell you to do in exam, but just have an idea that ultimately I told you, right, we need volatility to put in the Black-Scholes model. So we are looking at how do we estimate volatility. First, we collect the daily price data. Okay, so daily price data we collect maybe from Yahoo Finance, etc. We take it. Compute the standard deviation of the series of corresponding continuously compounded return. So you take the continuously compounded return and you take the standard deviation for that, right? How your continuously compounded return, you first of all find the mean, and then you say that how it is changing with respect to mean. Each entry is with respect to mean, right? Continuously compounded returns can be calculated like this. So they have given the formula also, right? That you have to find out returns. So you have the daily price data, which is SI. Let's say you have the 10th day price S10, 11th day price S11. If you have to find continuously compounded return, do this ln S10 S11 divided by S10. Right. Annualized volatility is the estimated volatility multiplied by the square root of the number of trading days in a year, right? Again, same thing. You find the daily volatility found out multiplied by root of 252. because you want to find 252 trading days are in a year, and you find the annualized volatility. Again, will this be asked in exam to do? No, this is practical steps, right? Nobody has time to ask you this thing, right? Because it's a practical thing. But what they're trying to tell you here is that one of the inputs of Black-Scholes model is volatility. You have to put volatility there. So how do you estimate volatility? So they are telling you to estimate more volatility. First, you collect daily price data, which is available from the exchanges or the stock market, whatever. Then you compute the standard deviation of the series of corresponding things. How do you compute standard deviation? First, you have to calculate the continuous commodity return, which is your S11 divided by S10, whatever. And then you analyze the volatility multiplied by the square root of the number of trading days in a year, right? Data period, they are saying that take 90 to 180 days of trading data is often sufficient, but the common rule of thumb is to use data covering a period equal to the projection period. So let's say you're projecting for 1 year, right? So a year's historical data for a year's volatility estimate, right? So general rule is that. But again, these are all practical steps not coming in exam. Impact of dividends. Okay, what about stock is given dividends? Stock price naturally decline on the ex-dividend date. When calculating your historical volatility, the best approach is to remove stock price changes on ex-dividend dates from the data sets, right? This is an approach when I teach practical stuff to people in quant finance, etc. This is what comes under data cleaning, right? When you have to clean data to get things, this is not. But again, these are all practical stuff. These steps are taught, or I teach them to students when I'm teaching them actual how to trade in the market, etc. Then I tell them that, okay, do these steps, do the data cleaning, and we have to put the formula for quantitative trading, etc. Right? But again, in FRM, you just have to know a little bit that, okay, fine. The best approach is to remove stock price change in ex-dividend dates from the data set, right? That's what we have. Now we are getting into Black-Scholes-Merton model, right? Black-Scholes-Merton model. First, we'll have to understand assumptions. Assumptions of the Black-Scholes-Merton model. Very, very important, guys, because see, ultimately, FRM is testing you on some few things, right? One of the key ways to test you is whether you understand the assumptions of Black-Scholes model or not. Then we have Black-Scholes-Merton formula, right? The formula is very tricky, but I'll give you a hack to understand it, right? So don't worry. Guys, please understand. If you ask me, sir, what question will come from exam or what question will come in exam from this topic, I can say with 90% certainty, the maximum chance of question coming in exam is from this assumption. Because FRM loves to test assumption of this model in exam, right? So read the assumptions properly, right? The Black-Scholes model values options in continuous time and based on a no arbitrage assumption. The key assumptions are the price of the underlying asset follows a log normal distribution, which we know, right? Which we have already studied, right? And we know the equation also. LNST, right? We studied the equation also. LNST, right, behaves like a normal distribution, and we know what comes in the bracket also. This means that the continuous returns are normally distributed, right? Price is log normally distributed, returns are normally distributed. Okay, understand. The continuous risk-free rate is constant, known, and always available for borrowing or lending, right? So this is again an assumption. Please remember, we are saying an idealistic scenario that risk-free rate remains constant, which actually in the real world does not remain constant, but we take it constant, always available for borrowing, lending. Trading is continuous. There's no gaps. The volatility of the underlying asset is known and constant, which is again not a correct assumption because we are taking volatility is constant. In real term, volatility is not constant. Trump has warned on Friday evening that a massive attack will happen in UAE, or not UAE, but in the Gulf region. So I don't know. Something is happening in Twitter right now. I'm teaching you. I hope the attack has not started. Right? Has it started? Some said, right, the attack will start, right? Not started yet. My phone was buzzing. But yeah, nothing has started yet. Okay, but most probably attack will happen tonight or something, right, in the Middle East, or tomorrow, right, whatever. Markets are frictionless, meaning no taxes, transaction costs, or restrictions on short sale or their proceeds, right? So again, very kind of idealistic assumptions. Markets are frictionless. Markets are never frictionless, right? There are no taxes. What a stupid assumption. Transaction costs, no. Again, stupid assumption. restriction on short sales or no restriction on short sale or proceed. But again, you have to remember, see, when you are building a model for the first time, you take a little bit of lenient approach, right? So this is the end of, because this is our first model, right? And one way you can think, sir, a lot of assumptions of this model are very stupid, right? Which are not applicable in the real world. I know, I understand. I clearly say markets cannot be frictionless. I clearly say there cannot be no taxes. I clearly say there cannot be no transaction cost. I clearly say there cannot be restrictions on short sale proceeds, right? I clearly say the risk-free rate is not constant, right? I clearly say there are gaps in the trading, right? So a lot of assumptions are wrong in the real world. But that was the first model, granted that much, right? 1970, the first time somebody came out with the model. So that's why he had taken whatever assumptions has to be taken, right? The underlying asset has no cash flow, such as dividend or coupon payments. The option valued are European option. That's why I told you last time when we solved a question on American option. That's why I told you that binomial model American option question will come, because Black-Scholes is only for European option. Black-Scholes cannot be applied on American option, guys. Keep that in mind, right? The European options, the option valued only European option, which can only be exercised at maturity. The model does not correctly price American option. For American option, the only three options are, or three ways are, your binomial model, your FDM, finite difference method, and your Longstaff-Schwarz algorithm. FDM, finite difference method, not in your syllabus. Longstaff-Schwarz algorithm, not in your syllabus. Only method in your syllabus is binomial method. Okay, remember that. Fine. Then we go into the next part, practice question. Which of the following is not an assumption underlying the Black-Scholes option pricing model? Tell me, guys. Tell me the answer. Give it a try. Which of the following is not an option?
Option A.
Not an option, right? You have to read the option. The underlying asset does not generate cash flow, right? It was an assumption, right? We took it, na? Underlying asset has no cash flow. It was an assumption. That's why I told you questions are not easy. So this is A is not the answer. Maybe not an assumption. Continuously commodity returns are log normally distributed. Returns were log normally distributed. Returns were normally distributed, not log normally, right? Option can only be exercised maturity. Correct. Right. The risk-free rate is constant. Correct. You're looking for the wrong answer. B. Log normally distributed were prices, not the return. Prices, right? So understand that part, right? Not D, guys. Read carefully. You guys are not reading carefully, right? FRM is all about preciseness. I have told you many times, right? See, clearly, I told you, right? Risk-free rate is constant, known, and always available for borrowing and lending. It's okay, you don't remember it right now, but go back and understand. The question had given a clear trap. They are in continuously compounded returns are normally distributed. Returns are normally distributed. Prices are normally distributed. Right? Prices. Read carefully, guys. Read carefully. Read carefully. Okay. Remember the assumptions. This is the question, pet question of exam. If I am setting your paper, I'll definitely ask. Right? Then we have this difficult formula, right? We have this difficult formula. Now, this formula troubles a lot, right? In fact, I'll be very honest, when I was giving this exam, right? This formula, I also never understood. I somehow mugged it up for the exam, went for the exam and passed, right? But I hated this page, right? I hated this formula because it was so difficult to remember, right? I was like, how do you remember such kind of formula, right? But I'll give you a hack. And once I give you a hack, you'll realize that remembering this formula is not tough at all, right? So let me give you a hack, right? This formula looks tough, but it is actually not tough. But that hack I never knew when I was giving exam. That hack I developed when I started teaching, right? So hack here is, see, what was the simple formula of call option, guys? Max of? Simple formula. What was the formula? Max of?
0, S minus
X minus X, right? X minus X more 0, right? So what I'm trying to say is that put S here. put minus here, put x here, right? Just write it little wider. Okay. Now, please understand that since we are getting into Black-Scholes-Merton formula, see Black-Scholes-Merton formula, if you remember our discussion on your binomial model, etc. See, we studied now that if we take infinite steps in binomial, if we take infinite step in binomial model, what do we get?
Black-Scholes.
Black-Scholes, right? We get Black-Scholes. Okay. So basically, just to put it in a very simple word, there are two worlds here, right? One is a world which is deterministic. Just try to understand like a story, right? Don't write anything. A deterministic world where we have simple formula like C is equal to max x minus x. One is a little a probabilistic world. Probabilistic world means here we talk in distributions. So Black-Scholes is a binomial model. Here is here. Binomial model is here. Black-Scholes is when we make everything continuous and we talk about distribution, etc. So S will be multiplied by a distribution called ND1. X will also be multiplied by a distribution ND2. But X, since X is a strike, right, we will take the current price of the X, right? So S ND1 minus X exponential minus RT ND2. That becomes the call option formula. I know you will say, sir, your logic is very vague. Yes, logic is very vague, but objective is that how do I master this formula, which is very complex. If somebody says that, sir, can we derive it? It's a two-page derivation, right? You want to see two-page derivation, I can show you also, right? But not worth it, right? What you have to remember is final formula. Again, I'm telling you, simple way to remember is, remember max, your call option is max of S minus X comma 0. Write S here, write minus here, write X here. S will have some distribution, that distribution is ND1, D1. X will have some distribution which will be ND2. Only thing is X is something which I have to take the present form, so X exponential minus RT. So it will become S ND1 minus X exponential minus RT ND2. That's it, guys. The exam will give you ND1 and ND2 values, you will get it. Similarly, for put option, you understand max of your X minus S, right? Comma 0. Again, write X here minus S. I told you X has to be taken a present value, X minus RT, right? And then ND2, X will always have ND. Okay, here it will be 1 minus ND1, 1 minus ND2. Small change. So here it will be not ND2, here it will be 1 minus ND2, and S will be 1 minus ND1. Again, I'm not deriving the formula, I'm just telling you how to remember this formula, right? Figure out a way to remember it. I have given you one hack. Then you have to remember D1 and D2 also, right? Here, don't remember D2. D2 is easy. Focus on D1. D1 is equal to ln S naught by X plus your R, risk-free rate, plus 1/2 sigma square, right? Into T, right? Into T, sigma square T divided by your sigma root T. D1 you remember, D2 is easy, D2 is nothing but D1 minus, remember this denominator, sigma root T. If anybody is thinking, sir, what is going on, please understand, everybody remembers it. When I was a student, I also mucked up. You are a student, you also have to remember. There's no other option, right? If you want to see derivation, if somebody is thinking, no, sir, I want to derive it, let me scare you more, right? Let's see the derivation of this on the internet. Obviously, I will not derive. So if you go here and talk about Black-Scholes-Merton derivation, right? You talk about Columbia University PDF. Let's see derivation. Right, Black-Scholes derivation. If somebody wants to see, this is the derivation, guys. If you're not happy with that formula, do this. You will be more unhappy in life. So do you want to be right? So you want to be more unhappy in life, right? You can try this, right? So again, if somebody is thinking that, sir, I don't like it. So this is the actual derivation, right? After doing all this work, you reach the final result, which is here. Okay. So don't go there, guys. Don't go there, right? Just to, I showed you for just to kill your doubts, right? So again, the idea is very simple here. Idea is very, very simple.
पढ़ाना कितना मुश्किल है
Yeah,
आप
yeah.
सोच आपसे बात कर रहे हैं
Yeah. So it's quite difficult, right? It's quite difficult. See, that's why I gave you hack, right? There is what I gave you is pure hack. There is no logic to it, right? This hack, this is all pure hack, right? Max of s minus x comma 0. You remember it, right? S here, right? Minus here, right? X here. Remember, x has to be discounted. X minus exponential RT. Put s nd1 exponential, right? nd2, right? For p, right? Max of x minus s comma 0, right? Here also.
लाइफ में कभी डिराइव थोड़ी ना करना है
Which one?
के लिए सिस्टम बना है
Sorry, I didn't get you. Hello. I'm not able to hear you. Your voice is cracking or something. Okay. So next part is x here minus R2. Right. Okay. So what I'm trying to say is that I will change my screen. Yeah, I've changed my screen. What I'm trying to say here is that here again I'm giving you a hack to remember, right? It is just I'm trying to help you guys, right? Right, x here minus here s here. X, remember x minus exponential RT you have to do. Here you do 1 minus, if you have done ND2 here, do opposite, 1 minus ND2. And here you do S into 1 minus, or don't write into because you might get confused that it's X or not. I'm deliberately not writing X and it's a multiplication symbol because sometimes people think that it's a X, right? I don't want to put S, your 1 minus ND1, right? So again, I'm just giving you a hack to remember, nothing else, in all this equation. And then D1 is equal to ln your S naught. I also don't remember now. S naught by X or what? S naught by X, right? S naught by X, RC, right? Right. S naught by X plus RC plus sigma square by 2 T sigma root T. Remember this denominator, D2 is equal to D1 minus this denominator sigma root T. So I've given you a hack to remember, right? I have given you, ultimately, if you can find a better hack, do that. But normally, most of the students remember like this, what I have told you, right? It's not difficult, guys. Practice it 3-4 times. I've done it in front of you, right? I can do it again. It's not easy. It's not difficult, right? Not difficult. Call option, max of, I'm just checking my screen. Again, I'm saying last time, I'm saying call option max of s minus x comma 0. Write s here, write minus here, write x here. Remember, x will have minus exponential RT every time. Right here you have ND2, here you have ND1. This is your call option. Put option, max of x minus s comma 0. Right. So put option will be x here, minus here, s here. X have to have minus RT. Only thing is here ND2, so it put 1 minus ND2, 1 minus ND2, right? And S is 1 minus ND1, right? That's it, guys. And then D2, D1. D1 is equal to ln S naught by X plus RC or R, whatever is free rate, sigma square by 2 into T, sigma root T. D2 is equal to D1, and remember the denominator minus sigma root T. So I remembered in front of you, right? Even though I keep teaching students, but I don't remember the formula. But if you follow this approach, this is it. So looks a very difficult formula. I also struggled when I was a student, right? But if you write it 5, 7 times, 10 times in notebook again and again, again and again, you will get familiarized with it. Ultimately, question will come on this, right? It's not that question doesn't come on this, right? Question come on this, they will give you ND1 and ND2, and you have to solve it, right? So this is this is a world famous formula, right? This is taught everywhere, B schools, etc., right? S not asset price, T is time to maturity, X is exercise price, RCF continuous commodity risk free rate, sigma volatility of continuous commodity return, N is the cumulative normal probability. Luckily, they will give you this value. Put call parity, you remember, I don't have to write it. This is the put call parity which you have already studied, right? Put call parity, remember now what was it? You had said C plus XX exponential minus RT equal to PS, right? I hope you remember this put call parity. This is covered in the earlier chapter, yes or no? Last time also we spoke about it that in American option, don't worry about calculating both things, right? So solve one and use put call parity to figure out other things. So not very difficult, but yeah, figure it out. So this is what I have done. See, I have written it here also in different ways, etc., so that it helps you, right? Use it again. Same thing which I explained you written here also, right? Figure it out, whatever you want to do. And again, there is some confusion can come that here I have written a formula n minus d2 and n minus d1. Please understand, n minus d2 is nothing but 1 minus n d2. So what formula I wrote there and this formula both are same. Don't get confused, guys. N minus d2 is nothing but 1 minus n d2 and n minus d1 is nothing but 1 minus n d1. Right? Don't go deeper. They will give you the value of ND1, etc. You only need to know formula and these small tricks, right? If you know that, you will be totally fine. Right? Same thing. I have again. See, I have put here again same thing. I have put here n minus d2 and n minus d1. You can change it to your 1 minus nd2 instead of this part. You can write this part. And instead of n minus d1, you can write 1 minus n d1. Okay. So again, I've done it multiple times, different ways, right? To help you guys. Put call parities also I put. Find out only one option, the other one you can use. Sometimes a very difficult question can be solved very easily using put call parity, right? So remember that part, right? A European put option has the following characteristics. S naught, this is S naught, guys. Little bit of typo. S naught is your, S naught is 50, X is 45, R is 5, T is 1 year, sigma is 25. Which are falling closer to the value of the put, right? Everything is given, right? Directly use Black-Scholes, right? Directly use Black-Scholes. Have they given ND1, ND2 is not given. So S is given, X is given, T is given, sigma is given, right? Okay. Find D1, etc. Okay. Here they have not given these values, but believe me, guys, this question is just because book wanted to test you and all that thing, right? So that's a different part, right? But the idea here is in the whole thing here is that this values will be given to you. This value will be given in exam, guys. Here they have told you to go and search in the cumulative normal table. Book will not, like exam will not waste your time, right? You can find ND1 and ND2 in cumulative table also, but we are not learning that part because that used to come very long back. Nowadays, they don't tell you to go and find the table. They give you the value, right? So that please remember that part. That's why I was surprised at how they are solving this question. Same thing here, same logic, go back and practice it. They are saying that we found the value from cumulative normal table. Again, this part will be given to you guys. you can find ND1 and ND2 from table, but in exam, they generally give you this value. They don't give you table, right? Table is not possible in a computerized screen. Table type question used to come in my time when the exam was pen paper based. That time table type question used to come because that time they used to give pen paper and booklet. There you have to see the table and find out the value. Nowadays, they don't come like that. Right? This is okay. Good part is I put it here also, but this is a quants topic, right? It is a quants topic. I've showed you how to find by table also, right? So good part is you can see by table also. Let's say my D1 came out 1.54. Let's say my D1 and I have to find ND1, right? I have to find ND1. So I have to find 1.54. 1.54 means 1.5 plus 0.04. So you take 1.5 top to down, 0.04 horizontally, right? 1.5 you take here, 0.04 you take 0.9382. That is the value of ND1. So I put it here, you can see it, right? Even though I'm 100% sure, 99.9% sure that you don't need to do this in exam, but just for 0.01%, let's say if they give you this, then you should be ready. Normally they give you the value, but let's say you you can find out D1. D1, you know that. D1 you can easily calculate. How you can calculate D1? You have to use the formula ln natural log of S by X plus R plus sigma square by 2 into T divided by sigma root T. D1 you will find out. Let's say D1 was 1.54. So break down 1.54, 1.5 plus 0.04. 1.5 top to down, 0.04 horizontally. So 1.5 here, 0.04 here, where they match 9.382. This is this. Then you say, sir, how do I find n minus D1 if they ask me n minus 1.44? Nothing. You have to do what? N minus D1 is 1 minus ND1. Nah? So you find ND1 only and then you do 1 minus ND1. Okay. So you actually don't worry about your finding n minus D1, right? That's why, again, you should know the conversion, right? Don't worry, sir. How do I find n minus D1? N minus D1 means 1 minus ND1. ND1, you know how to formula. Just do 1 minus that thing, right? That is your n minus D1, n minus D2. So I have given everything in the notes, extra things also, but chances of this coming in exam is less, right? So just if it comes, you know the hack here also. And if some people have not studied quant, this will come in quants also, so you should know that. Okay. Then we have another question. Find the value of put option using put call parity. Again, go back and practice it, guys. Just call option is given. Put call parity, just put it, find the value, right? Nothing so special, right? Just put the value, find out the answer, right? I don't think there should be any challenge. Do practice this question, guys. I'm going a little faster, but do practice. Question number 7. Stock ABC trades for 60. 1 year call and put option return on it with an exercise price of 60. The annual standard deviation is given. Confidence compounded history is given. The value of both the call and put using BSM, which are the following, right? Call and put option value has to be figured out. Find out one value and use your put call parity, right? So that is what they would have done. Yeah, so they are doing the same thing. They found D1, they found D2, right? Found out call option by using the formula which I told you, S0 into ND1 minus X exponential minus RT ND2. They found this thing. Find out one by formula, guys, and don't waste your time again using the formula. Use put call parity to find out. Same logic was used in your previous chapter also. So put call parity is very helpful. You don't need to go, all calculation mode, right? You don't need to do that. Okay. Next part, right? So I have given you the hint of the questions. If you are not able to solve, let me know. But the idea is that you can solve it, right? That you have to practice. Last part, which is your dividends, warrants, and implied volatility. Please understand. We'll look at valuation of European option, impact of dividend on American option, valuation of something called warrants, volatility estimation. Volatility, you have already figured out. In the first module, you saw how to estimate the historical volatility. Here you look at volatility estimation, right? The first part here is valuation of European option, right? See, again, you've already done it. On non-dividend paying stock, you calculate directly using the BSM formula. So that is simple. On dividend paying stock, please remember, in the Black-Scholes assumption, we said that the underlying asset has no cash flow, right? For a continuous dividend yield, what will happen is you will have to substitute S naught by S naught E minus QT, right? So same thing I told you in a lot of specialized question in your. You remember last time also I told you same logic when I taught you binomial model, that if a stock is giving dividend yield, you have to change the stock everywhere by this. You remember, na? Yes or no? I told, right, that you have to change it, right? So yeah, that's the point, right? Same thing. Cash flow, dividend, increase, put values. Obviously, dividend is a gift which is subtracted from the stock, right? So the stock price will come down. The stock price will come down. It will increase the put value, decrease the call value. If the dollar amount of dividend is given, compute the present value of the dividend. Again, if dividend is given directly, subtract the stock and subtract the amount from the stock price S naught before applying the BSM model. So that is the thing. If dividend yield is given, then go this way. If dollar amount is given, go this way. On foreign currency, this also I told you. Same logic I told you in foreign currencies also, that if foreign currency given, only thing is that the foreign risk-free rate is substituted for the continuous dividend. So instead of Q, right, you get S naught minus E, RFT, right? So instead of Q, you put RFT. In your Black-Scholes model, it was RDC minus RF. Here it is not RDC minus RF, the exponential minus RF only, right? On futures, you have again stock price is replaced with future price. So same thing, the S naught is replaced by future price. So F naught into exponential minus QT. The dividend yield Q is replaced by domestic risk-free rate. If you ask me, will this be asked in exam? No, right? See, FRM give these things just for you to know, but at most they can ask you this thing. At most they will ask you. They don't go here. Nobody asks about futures. Maybe for foreign currencies, maybe, right? But highest chances are here. Higher chances is normal Black-Scholes model and maybe a little bit of dividend paying stock. They will not go into futures and foreign currencies, but just know that. That's why the questions are also not there. It is just giving you a hint that if at all question comes, be ready for it, right? This is one of the questions. Assume a stock price of 35 is a continuously compounded dividend yield of 2.5. Dividend yield is given now. You have to change. There is 6-month call option on the stock with exercise price. So, what is the adjusted stock price to use for the Black-Scholes model? So, S changes to S naught exponential minus QT, right? Which is your 35 into exponential minus QT, right? This is Q given, right? Which is there. This is Q given and T is 6 months, right? So, understand, right? The questions are not that difficult if you remember that. Impact of dividend on American option. Remember this theory, guys. This is asked in exam a lot, right? So this is important. Theory, only theory. When no dividends are paid, there is generally no difference in value between American and European call option, as early exercise is not optimal, right? See, if no dividends, generally nothing much difference between American, European call and European put, right? But let's say there is dividend, right? Because we are looking at the learning's objective is dividend. Now, remember this comes in exam directly as a statement. You have to remember it, mug it up, right? In American call option, dividends complicate the early exercise decision because the dividend payment effectively decreases the stock price. Early exercise becomes more optimal. The closer the option is to expiry and the larger the dividend. An investor will exercise early if this is the mathematical relationship. Remember this, right? See, the idea here is you will exercise early if your dividend at a particular time is greater than your exponential x1 minus exponential minus r t minus tn. I don't think numerical will come here, but the idea of studying this thing is only one, that we must understand that in American call option, if the dividend is larger, dn is very high, and we are closer to expiry, early exercise becomes optimal, right? For American put option, early exercise becomes less likely. With larger dividends, the value of the put option increases as the dividend is paid, right? Simple point which comes in exam is that for early exercise, which of the option is, more optimal, right? So early exercise more optimal for American call option, not for American put option, right? Remember, this comes in theory, not numerical, etc., but just have an idea. Same thing I told you, right? Compared to the value of call option on a stock with no dividend, a call option and identical stock expected to pay a dividend during the term of the option will have a what? Lower value in all cases. Again, not in all cases. Lower value only if it is an American style option, higher value only if it is an American style option. What is it? See, if you are comparing a call option, right, on a stock with no dividends, right, a call option on a identical stock expected to pay dividend, right? If there is a call option, right, on a stock which is paying dividend, right, that call option will be lower value or higher value, right? See, it will depend, right? It will depend during the term. And the question is asking a call option on identical stock expected to pay a dividend during the term of the option, right? We're asking during the term of the option. Which one is more likely, guys? Like, what is happening here? Is it lower value in all cases? Higher value in all cases? Lower value only if it is an American style option, higher value only if it is an American style option. One side there is no dividend. One side there is your option which has dividend, right? This is dividend, and this is no dividend. So what we read in the previous slide, what we read in the previous slide, that, and the question is about call option. Dividends complicate the process because dividend payment effectively will decrease the stock price. Early exercise becomes more optimal closer the option is to expiry and larger the dividend, right? So idea here is, right, that please understand, right? A call option, when we take it, the call option is stock with no dividend is compared with call option on a stock that pays a dividend. Now, what is asking? What is the question asking? Compared to the value of a call option on a stock with no dividends, a call option on an identical stock that pays a dividend during the term, will it have lower value, higher value, or what is the case? Tell me. And how do you solve it? Any logic here? Anybody is able to pick it up? This question, I'm not happy with this question for one reason. They are not talking about early exercise anywhere compared to the value of call option on a stock with no dividend. A call option on an identical stock. Oh, got the idea. See, this question is a super easy question, but our mind confuses here, and that's why I was a little confused, right? See, since we read about early exercise just now, we are thinking in early exercise terms that, oh, early exercise will happen if there is a higher dividend and closer to expiry. But this question does not mention early exercise. There is no word here called early exercise. Right? In this question, there is no word called early exercise. This question is actually not about early exercise. This question is normal question is asking that there is stock which pays dividend, there is stock which does not pay dividend. So if a stock pays a dividend, tell me what happened to the stock price? It goes up or down? If stock pays a dividend, what happened to the stock price?
It goes down.
Down. If stock price goes down, what happened to the call option? Simple. Stock price goes down, what happened to call option? Goes down, na? Because call option becomes more better when the stock goes up, right? Down, right? So simple, right? It is lower value in all cases, right? Again, this question becomes confusing because we kind of search early exercise thing here, but this question does not mention early exercise. This is a very simple question, but again, mind gets tricked here, right? So yeah. Then valuation of warrants. There is something called warrants, guys. Warrants. Again, a very small topics, but your book love it somewhere. Warrants are attachments to a bond issue that grant the holder the right to purchase shares of a security at a stated price. Please understand. Warrants are attachment to a bond issue. And if somebody has got the bond, it grants the right to purchase shares of security at a stated price, which is generally lower than the market price. Warrants can be valued at a separate call option, right? So remember this line theory on the firm share, right? Because you're able to buy, let's say 700 rupees share, you're able to buy for 550, right? Unlike call option where shares are already outstanding, exercising warrants involves purchasing share directly from the firm, right? This can affect the value of all outstanding share, leading to dilution of equity per share, right? See, in warrants, the company is giving you a gift kind of thing that you can purchase the stock of the company, but you will not purchase the stock of the company which are already available in the market, right? You will take the stock from the company, right? And when you take the stock from the companies, the dilution will happen in the company's shareholders. So dilution cost, again, remember the final formula. That's my, don't focus on the derivation. Assuming no benefit to the company for issuing warrant, the value of each warrant is computed, data. Again, don't bother, guys. Like, you want to learn derivation, you can, but nobody will ask you derivation exam. What will come in exam is, they will give you directly this question. Find out the value of each warrant. Remember this part. Remember this part, value of each warrant is N divided by N plus M into value of regular call option. N is number of shares outstanding, M is number of new warrants issued. So N, value of each warrant, N divided by N plus M. And company stock price is expected to decline by this. So just remember these two formulas. Don't look for derivation. Don't waste your time in unnecessary things. Value of each warrant, N divided by N plus M, any number of share. Company stock price expected to decline by this. The question will be direct. They will give you, find out the value of each share and find out the value of how much the stock price is expected to decline, right? That's all. See, this is the question. There are 3 million outstanding shares of ABC stock, $42. ABC considering issuing 1 million warrants with a strike price of so and so. If the current value of one European call option is this, expected price of stock is this. What is the expected stock price after announcing the warrant will be closest to. So you are looking for stock price, right? So in the previous slide, you learned that the below formula was for stock price. The question is for stock price. Question is the expected stock price after announcing the warrant. So they are asking for expected stock price. This formula gives you expected to decline. So this formula gives you how much you have to subtract. So basically, the current formula is 42. Use that formula to find out what I should subtract and get the answer, right? So X I have to find out how much subtraction I have to done. Subtraction is M divided by N plus M, right? And that call option value, which is nothing but 2.12. It is so simple, right? X is this value, find out, right? So again, focus on the right things. Don't kind of do something else, right? So see this. M, this is M, this is N, this is M, this is call option price, 0.53. This is basically X you calculated, you subtracted 42, you got 41.47. Very simple question, guys. Very simple question. Two formulas. One formula is for finding out the value of warrant, right? Value of each warrant, right? That is N divided by N plus M into value of call option. One is decline. So how much subtracted? M divided by N plus M, value of regular call option. Just remember two formulas. Read the question. Question is asking stock price closest to. So original stock price 42. I have to subtract decline. Decline is M divided by N plus M into 2.12. Just put the value and find out. Very simple and straightforward. Then we go into volatility estimation. I told you volatility has to be studied properly because it's the input to Black-Scholes. We studied historical volatility estimation. I told you find out, take the data from Yahoo Finance for price change and then find out the returns, then take the standard deviation and then do all these things, right? Here we are talking about another concept called implied volatility. Implied volatility is not historical volatility. Historical volatility got from the historical data. Implied volatility is standard deviation of continuously compounded rates of return that is implied by the market price of the option. So it looks like a tough definition, but idea is you studied Black-Scholes model, right? In Black-Scholes model, you have the full formula. What we are saying is that the call option has a full formula, right? I can go to the notes, right? So see the call option has this full formula, right? The call option has this full formula. Now, if I tell you that go to market, pick up this price on the market, this stock price, right? And just put the value, ND1, you'll find out the value of sigma. Let's say using the market price, which is available, you do and find out the sigma. See, Black-Scholes was what? In Black-Scholes model, you put the value of sigma and found the call price. Here, I'm saying the opposite. I'm saying, no, don't do that. Put the call option price from the market, find out the sigma. So if you find out the sigma this way, that is your implied volatility, right? So implied volatility is nothing but a kind of a reverse engineering you are doing. You are taking the market price of the call option, right? And using that, you are trying to find sigma. That is implied volatility, calculated using Black-Scholes option pricing model along with market price of option solving for volatility, which I told you. There is no closed form solution. It must be found by iteration. If BSM calculated call value is less than market price, volatility needs to be increased until the model value is market price, and etc. etc. Nobody will ask you this. Just remember the definition. Historical volatility you found earlier. If the standard deviation of continuous compound return for the underlying asset, it can serve as the basis for future volatility, but may not always represent the current market. Steps for competition: convert prices to returns, convert returns to continuous compound return, calculate the variance of standard deviation. Again, nobody will tell you to do it. Nobody has, like FRM doesn't ask such question. Right. Let's do a question, guys. Which of the following statement is most accurate regarding implied volatility in Black-Scholes model? Volatility is constant across strike prices. This is not for implied volatility, right? This is for historical, right? Volatility is most accurately applied using historical return. Again, no. The process for estimating volatility involves 2 steps at most. No, there are 3 steps, right? Volatility is often derived using Black-Scholes market price and other inputs, right? So these are right. No, there were not 2 steps, there were 3 steps, right? So I hope you remember the previous slide, there were 3 steps, right? Convert price to return, convert return to continuous compound return, calculate the variance of standard deviation, right? So yeah, that's it, guys. But again, just to give you a kind of a debrief, right, before we close the lecture. See, this chapter is tough, right? And if you ask me how many questions will be asked here, I think they will ask you, in worst case, they will ask you 3 questions. In good case, they can ask you 2 questions, right? So this chapter will have 2 to 3 questions, right? That's what. If you ask me what they will ask, see, 1 question will come from assumptions. 1 question will come from distributions. 1 question will come from numerical, right? So it's a very simple kind of chapter, right? 1 question will come from here. If let's say there are 3 questions, 1 question will come from here. Stock prices, what distribution, stock return, what distribution, what is mean, what is standard deviation, etc., etc. So 1 question will come from here, right? So this is why I explained, right? Then nothing here. This is, you can understand, nothing much. I don't think anything will be from here. 1 question can come from assumptions, right? This is favorite part of exam. Second, right? Then 1 question can come from this calculation of numerical, right? Don't waste your time in going too much deep, right? Especially this part where solve this numerical, how to solve table, etc. I've given it here. That also is available with you, right? But don't waste your time in what I wanted you not to waste time is not here, but where is that future and all those things, right? Don't waste your time in that. Yeah, don't waste your time in this. This, like, to be honest, they will never ask. I have never seen a question on futures. Like, I have never seen a question on futures. Rarely on foreign currencies. If they want to trouble you, they will ask you this question. But they will not, like, don't go too far, right? Just remember the formula. If it comes in exam, do it. If it doesn't come, and most probably it will not come. So don't waste your time too much here, right? Then here also they can ask theory. Sometimes if you are unlucky, they can ask theory from here. Only line. Don't focus too much on the formula. Just remember that American call option, good to exercise early. American put option, not to exercise early. Just remember 1 line, right? Both places. And then valuation of warrant, again, One is value of each warrant, and one is expected decline. How to use it, understand. So there are 5-6 questions from this chapter, right? See why these notes are given, etc. Implied volatility, just the definition. Right? Why these notes are given to you and why all these things are taught in a particular way is that we try to tell you that, see, the chapter might be very long, but examiner cannot ask you more than 3 questions. There are only 5-6 questions which can be asked from this chapter, which are worthy to be asked in exam. So if you remember those 5-6 topics, right, which are assumptions, distributions, calculation of numerical, 2 lines on early exercise, and 1 warrants. I'm telling you, right, you can note it down right now. Out of these 5 topics, 3 questions will come. 1 question will come on distributions, right? 1 question can come on distribution, 1 can come on assumption, 1 can come on numerical calculation, 1 can come on early exercise of American call, American put, and 1 can come on warrant calculation. Out of these 5, 3 questions will come. So chapter is so simple, right? Chapter is so simple that I understand that you're reading for the first time and it's difficult, but you should also be smart here that what examiner is trying to test, right? So examiner will not there's nothing more to ask, right? There are 5 topics to be asked in exam. The last 5 out of 5, 3 will come in exam. You have to score marks and move ahead, okay? Anybody any doubt? Anyone, any doubt, any thought, anything? Nothing? Go back and practice the numericals, guys. I have given you the hint, lot of questions. I deliberately didn't solve it because I could have solved it. Here, that was not any problem for me, right? But go back and solve yourself, right? And also remember, ND1 and ND2 will be given. But in the worst case, just understand how to find from the table also once. I've given the screenshot. I have put everything. Understand n minus d1 is 1 minus nd1, n minus d2 is 1 minus nd2. So that also is resolved. And there are 2 formulas which are given, that also kind of perfectly resolved. I have given, right? You want to write n minus d2, n minus d1, or you want to write 1 minus nd2, 1 minus nd1, your choice, right? You can do it. And how to remember the formula, that also hack I have given, right? Clearly hack I have given. With multiple colors I have written st into nd1 minus x exponential minus rt nd2. It's very simple, right? So how to remember st, take it here, x take it here, minus take it here, nd1, take the present value, nd2. It's very simple, right? Go back, practice it. You will totally fine. Okay. All right, guys, we'll stop here. Okay. Thank you.